We're here to talk about Silicon Valley real estate markets Saturday, May 10th, just the day before Mother's Day. These are the key chapters that we're going to be going over. There's a timestamp in the YouTube description that you can jump to the chapters you like the most. We're going to start off with some additional slides this week. The first group you've seen from the last couple of weeks. This is simply the number of offers accepted the past week. And it gets a little complicated because you have Easter and you have COVID in here. And that's where we're going to see the new slides. I'll adjust for it at the end. But basically, you can see the sales for Silicon Valley, Santa Clara, San Mateo, and Alameda County are very low compared to where they normally are. The blue line is the least you'd expect. The gray line is where you typically expect. So you'd be expecting to be up here somewhere around 650 transactions. Meanwhile, you're down here at something like 500. You're missing almost a quarter of the marketplace. Here is Santa Clara County. It's in a little worse shape because you're right on top of the blue line. And in rough numbers, you're looking at about 175 transactions when you should be up here around 250 transactions. So you're actually missing about 75 transactions on 175. So that's fairly significant. Moving on to San Mateo County, it's actually doing fairly well. I mean, the dip down for Easter was a little more significant than you might expect, but you're up close to the realm of normal. And that's interesting, is that people that have more wealth, but San Mateo County is no longer more expensive. So anyway, there's a huge difference between Santa Clara County was down here in the blue. San Mateo County is up almost on the gray line, almost the level of inventory you'd expect. So let's move on to the tiebreaker, Alameda County. So let's see where it's at. And it's in between. So you have Santa Clara County, which is one of the two big ones, which is way down the blue line. You have Alameda County, which is halfway between the blue line and the gray line, and San Mateo County, which is actually approaching the gray line. You know, I don't know what to make of the difference in the three counties, but that's one of the reasons you look at the data. Now, we're going to have to leave PowerPoint for a second and go over to my actual Excel spreadsheet. So what I've basically done is this sort of the same exact concept, but now what I've done is I've gone back and dropped off Easter by taking the average of the week before Easter and the week after Easter and putting that data in for Easter. And I also went back when COVID was really impacting us, basically March 1st, which, you know, might sound weird, but when you have sales that are in escrow, more buyers were failing escrows with the shelter-in-place rules, and therefore the number of offers that were accepted back in March 1st that were still valid actually decreased. So I eliminated March 1st for 10 weeks, and now what you do is you have a blue line that is much more normal. So you basically eliminated Easter from the blue line as well as the gray line and the red line. And now you're comparing them. So now where you're saying is Silicon Valley is basically right at the least inventory you'd expect. Moving on to Santa Clara County, it's below the blue line. So it's below the corrected blue line, which I think makes it a little easier to understand. But now let's move on to San Mateo County. It's still doing very well. It's basically almost up to the gray typical corrected line. And by corrected, again, I've eliminated the impact of Easter and COVID, at least the best that I think I can quickly, because I didn't think of this until this morning. And then moving on to Alameda County, it has come down and is basically close to the blue line, but only because for whatever reason, the week is high right now. You know, it's a peak up. So will it come back down? Because you can see the 10-year spike is week specific, which is a little unusual. So I don't know why Alameda County has a spike up that significantly. And if Alameda County comes down like next week, like I sort of suspect it might, then it's also in the blue. So now with the corrected data, you have both Alameda County and Santa Clara County right at the sort of the least amount of offers you'd expect, and San Mateo County performing almost normally. And I do have no explanation at this moment in time for why the difference between the two performances. Let's get back to the normal presentation. And here's the normal summary slide. This is where I normally start the presentation. And you can see inventory is going to continue to grow. And this week, right here in the center of the graph, is significantly above the blue line. What am I talking about significantly? Well, you're 35% higher than the gray line, which is where you'd expect inventory to be. And in numbers, you have 3,200 listings available. Typically, you only have 23, and the most you'd expect is 2,900. So 2,900 is already a surplus, and we have 10% higher than our surplus level. Moving down to offers accepted, same concept. Offers are floating just above the blue line, but what are we talking about? Well, a quarter ago, back here 13 weeks ago, we were at 82%, and now we're at 75%. And you go, how can that be, Richard, when you're higher above the blue line? The percentage is based on the typical gray line. And if you look now, you're significantly further below the gray line here on this current week than you are over on the left-hand side 13 weeks ago. You're much closer together. So now in a time when inventory has gone from 5% more than expected to 35% more than expected. So you've had a growth of 30% of your inventory. Offers have gone from 82% down to 75%. So you've lost 7% of the offers at the same time you've gained 35% of your inventory. And then related to offers down the road, closings, they're actually performing a little bit better because it went from 71% of the number of transactions you'd expect 13 weeks ago up to 78%. But we're still lagging. We're at 2,000 transactions, and that would be about 2/3 of the way down to the fewest, if I'm doing my math right, from the 2,600, which is the level you'd expect. So you're missing 600, and you're about 300 or higher than your fewest. So it's about 1/3, 2/3 of the way down to the fewest. So again, fewer transactions, but this would suggest, because the number of closed transactions, the percent of closed transactions is higher than the percentage of offers, it would actually suggest there are fewer transactions failing now than there are typical, which is sort of not what I would have expected with the amount of uncertainty and back and forth and everything that is going on in the economy and the world. Moving on to days unsold inventory. So this is now taking a ratio between the inventory and the offers accepted. You went from 15% above normal, which is slower than normal. The higher the DUI, the slower the turnover rate, the slower the marketplace. And you can see you were up near the blue. Then we hit the blue line and we crossed over, and now we're significantly above the blue. And our days of unsold inventory now is 70% slower than you'd expect. That's almost twice as long to take. But still, keep in mind, the speed, Silicon Valley is normally a race car going down the full throttle. Even if you're at half throttle and you're going down at freeway speeds, you're still covering a lot of ground. So let's look at this. Even though I'm talking about being 70% slower than normal, we would sell out the entire inventory that we currently have at the existing rate of sales in 51 days. So yes, it's slower than the 30 days that we would expect, but you go anywhere else in the country and they typically would talk of 3 to 7 months of being the normal turnover rate. 50 days is still less than 2 months. And one of the reasons I talk about days of turnover, days of unsold inventory, is because the numbers are so small, it would be ridiculous to talk about fractions of days. It might make more sense for me to talk about it in terms of weeks. Back here you were at 6 weeks and now you're at 7 weeks. But, I've stuck with days and I like days, so we're sticking with days for the time being. Moving on to marketing time. This is an easier concept to understand. Simply, how long is it taking for the sellers to sell? This is for 3 out of 4 sellers to sell, but it doesn't account for the sellers that come on the market that try to sell that aren't successful. But your marketing time went from 14 days, and to sell 3/4 of your inventory in 2 weeks is pretty good, to now up to 22 days or 3 weeks. But let's look at what we've done. We've gone from 31%, so 1/3 the time to sell back here only 13 weeks ago, because you're below the red, so you were hotter than red. Now you're cooler than blue, and you're at 150%. So you basically tripled to get up to 100%, and then you added 50% on top of that. So we're about 4.5 times slower now than we were just 13 weeks ago compared to where the market normally is. You can see the market normally comes down during this period of time. What happened was the improvement happened earlier this year for whatever reason, and it's fairly rare for me to have a time shift, but we clearly had a time shift, and I can try to remember to point that out later. Sellers' expectations versus market reality. This is their price reductions. You went from a little bit less than normal here just 13 weeks ago. You went from 75% of typical, which is only 0.4% reduction because the vast majority of sellers take no price reduction, to now where you're taking significantly more price reductions than normal. What's significantly more? It's almost 3 times more. So you went from 3/4 of normal to 3 times normal. But then when you look at on an amount, it's still only 1%. So it doesn't sound like much of a price reduction, but where you'd expect to be is at 1/3 of 1%. And in a soft marketplace, you'd only expect it to be 2/3 of 1%. And yet we're essentially at a full 1% discount. And that's sellers reducing their price voluntarily to try to entice the offers to come in after they went on the market and set their list price. Overbidding. This is more on here for a curiosity thing, and there seems to be a lot of interest in it from consumers. It's a lagging indicator. It doesn't tell you where the market's going. It tells you where the market's been. And you can see that we were above the typical, higher than the gray line on the red side. We've crossed over just this last week from typical to slightly below. What's that looking at? Well, 13 weeks ago, we typically have 3.2% overbidding. This year, 13 weeks ago, we had 4.3% overbidding. Fast forward to this current week, we typically have 7.6% overbidding, and this year we had 7.1. Your high side is 12.6, and we're clearly not there. And even in a slow market, we still expect in the Silicon Valley sizzling marketplace to have 4.5% overbids. And that's something that a lot of people just don't seem to understand, that Silicon Valley is its own entity. And to overbid at 4.5% in a slow marketplace sounds crazy. Right now, we're overbidding at 7%. Now, one reason this doesn't tell you where the market's going is these offers were accepted when the offers, 5 weeks ago when the offer was negotiated. Then you go into escrow and then you close. And then from 5 weeks ago, I have to look in the back rearview mirror, and I elected to go back 5 weeks to get data. Now, I didn't just arbitrarily pick 5 weeks. I actually looked at stability of data from 1 to 6 weeks, and it was a toss up between 4 and 5. And because of the spacing of holidays, I selected 5 weeks. But, I have used a 5-week benchmark since 1997, and I'm sticking with it. And I think it makes a lot of sense. It also aligns a lot with a month, because almost everybody else reports monthly data. I think real estate's far more weekly, at least in Silicon Valley with open houses and things of that nature. And then, the whole marketing situation, you put the house on the market this week, you do open houses this weekend, and then you look at offers next week. There's a huge weekly cycle. And there's also a tendency for escrows to close towards the end of the month, especially as interest rates start climbing again because of prepaid interest. And sometimes those slip 1 or 2 days into the following month. So by going for 5 weeks, I have a few days at the beginning of the month where you normally have very few closings, and I can incorporate that backwards essentially into the previous 5-week period of time. Anyway, get sidetracked. Here now is looking at the key indicators over time, and I did have to change axes. I was capped off at 170% last week. I'm now going up to 200%. I jumped up quite a bit because it's a fair amount of work to generate this graph, because there's 2 graphs. There's the compressed scale to the left of the vertical green line and the expanded scale to the right. It's basically a 2-to-1 factor. You can see how close together the quarter line vertical gray lines are back here and how spread out they are. And that's done so you can, one, see the 10 years worth of data that I'm using to come up with my data set. And you can also see trends on the full year plus the current year. Purple line is inventory. You can see that inventory compared to normals come up. And we're now sort of hovering somewhere around 135, 137% of where you'd expect it to be. So a third more inventory than you'd expect. Going down to offers, you can see that offers are still declining. It does look like it's starting to roll out and maybe plateau. So we may end up down around 73% or 74%, but we have less offers and more inventory, or we have more inventory and less offers. That causes your ratio between the two, the turnover rate, the days on unsold inventory, to go up. And right now you're at the 70% higher than you'd expect, which again is a 70% slower marketplace than you'd expect. Not quite double, not quite twice as long, but approaching twice as long to sell properties. Here now is looking at just the inventory. You can see the blue line is the most inventory you'd expect. The gray line is where you'd expect the market to be. So right now we're somewhere you'd expect the market to be somewhere down here around 2,400 listings, but instead we're up here around 3,200. So you have about a third more listings than you'd expect. You can see it's following the normal pattern. It's just the rate of climb is steeper. And it is noteworthy. Basically, just last year, we were on the red line. So the last half of fourth quarter of 2024, we were basically had a shortage of inventory that lasted through New Year's. And then right after New Year's, quickly you came up to normal. And then by the middle of January, you were coming up to high level of inventory. And basically second quarter has been high level or above high level of inventory. Here is looking at the percentage basis. And this now lets you go back and say, we're basically at a record high, except right at the end of 2018 and 2019. And that was after 2017, where we had a double year of appreciation, basically one in January, one in August. And then the following year, 2018 was sort of a sluggish year. And then he started off 2019 sluggish, and then he accelerated into the pandemic. Here's looking at the number of offers accepted. You can see that and it's the vertical separation, not the horizontal, because you're closer horizontally, but your vertical separation here, you're somewhat above the blue line. You're close, especially if you tend to do shortest distance, you appear to be closer. But again, it's the vertical separation. And you had this little dip, but notice how you're coming back out. So you clearly had a slowdown in the marketplace that is not typical for this time of the year, because you can see typical is the gray line, and it's just going right up. And normally we're still approaching the peak. So this year, something happened right around the beginning of the second quarter. We had this dip going down, and now we seem to be turning around and coming back. So we haven't continued to grow like we normally do, but it looks like we're doing a little bit of a recovery as far as the number of offers that are being accepted. Here's looking on a percentage basis, and you can see we're basically in the same magnitude that we were in 2024, and we were above where we were in 2023. Now, remember in 2022, we had that huge price correction and this huge slowdown in the marketplace, and the volume really didn't recover, and it hasn't recovered since. You can see is it pandemic related where you had normal inventory level, a number of offers back here, then you had high offers when everybody's needs changed with the pandemic, and then you had the 2022 slowdown right here. Notice the vertical, almost straight down slope, and then all of 2020, the second half of 2022 and all of 2023, we had significantly less offers. We picked up to about 80% for 2024, and now we've done a little bit of a sine wave for 2025. And again, you can't predict the future, but right now we're somewhere around 75% of the offers that you'd expect to have for this time of the year based on the past 10 years. Here's looking at the days unsold inventory. So it's the ratio between the inventory and the offers accepted. You can see we're up here at just around 52 days to sell your inventory, but it's way above the blue line and it's way, way above the gray line. So you'd expect to be down here at 30 days. You're up here at something like 52. In a slow marketplace, you'd be expect to be somewhere around 42, and we're still 20% higher than that, or 25% higher than that. So clearly the Silicon Valley is slower than Silicon Valley normally is. It's still fast at 52 days compared to anywhere else in the country that I'm aware of, but it's slow for Silicon Valley. Here's on a percentage basis. You can see again, I expanded the scale from 170 up to 200. And that's because I already explained that. So you had one time during the COVID shutdown, and you had one time right at the end of 2018, right going into the holidays, where you had a slower, even a slower than typical, slower than expected market turnover rate. But right now you're at 70%, and you're not 100% in record territory, but you're darn close to being in record territory for the past 10 years. Here's the marketing time. Look at how quickly that's gone up. And this is the shift that I was talking about. See how the shift on days on market typically happens halfway through second quarter? It happened back basically on New Year's, and we came straight down like we normally do. We bounced around the bottom, and we're going back up, and we're going up. The bottom wasn't as long as it typically is. Look at how long the gray line's sort of at the bottom here. And then the rate of increase here is basically matching the typical rate of increase. So the shift in the calendar here was about a half a quarter. The shift in the calendar here is approaching a full quarter. It's not quite a full quarter, but it's definitely expanding. And I don't understand what's causing the time shift. Here's compared to normal. So the marketing time is, 148, 147% of normal. And again, it's, you get up to 150% and you're at record territory. And this doesn't look like it's changing. The percent of normal for marketing time looks like it's going to continue to increase, and we may be in record territory. Here is the seller's ask price reductions. And then this is the 10%. So you go from the seller that's taking the highest percent reduction to the one that's taking the lowest, and you rapidly find out about 85% of the sellers take no price reductions at all, which is why I look at the 10%. So that's what I'm doing. I'm looking at the seller, the 10th percentile seller, how big was his price reduction? And basically it's down here at something like 13%, which is pretty significant. You'd expect it to be up here at 10%. So it's basically 30% larger price reductions. What does that mean? It means that sellers that went on the market in the recent past went on the market with a set of expectations on what the market was going to be and set their sale price accordingly. And then when they came on the marketplace, they found out that that's not where the market was, and they had to take more or larger price reductions. And since this is looking at the 10 percentile, this is saying larger magnitude of price reductions because the 10 percentile is always going to be 10 percentile. Here's on a percentage basis. And again, you can see we're in near record territory in the 2022-2023 timeframe when we had what I believe was the largest price correction in my 45-year career happen in a fairly short period of time. Is the only time when we had more price reductions compared to typical. And so now if you were looking for optimistic news, look at this downturn. I mean, it's down ever so slightly from last week, but you're still 60% higher than you'd expect it to be. Here's now looking at the average sale price reduction. So this is just for those that think I'm playing games. You can see you had a slight uptick from last week, but here you're 1%. So, here's where you're talking about much smaller numbers, but keep in mind, look at where you normally are. You're normally up here at somewhere around 0.3. I think that was what the number was from earlier as well. 0.3% reduction. Now you're taking a full percent reduction. So when you're looking at the average, it could be either higher magnitude or higher frequency of price reductions, or a combination of both of those factors. Here's looking at, and you can see there's times when the average price reductions were lower, both in the early 2019 and early 2023, as well as the latter part of 2022. We're not in record territory, but we're lower than you'd expect. We're taking larger price reductions than we normally do in Silicon Valley. Here's the frequency of those price reductions. So you can see they are more frequent. We're almost up to 15% of the sellers are doing price reductions. You'd expect the number to be down here somewhere around 7 to 8%. So you're almost double, 80% higher than the level. And this means it's broader base. In other words, instead of 10 sellers reducing their price, it's 18 sellers reducing their price. It's, increasing frequency. It's going to be easier to find listings that have had a price reduction. And I don't talk about the significance of the price reductions. I try to eliminate data corrections, but if some listing agent and seller want to reduce their prices $10,000 when their home's $2 million, they're free to do so. That will count as a price reduction and impact my frequency. That doesn't happen very often, but I just want to make it clear that I don't have a magnitude limit on it. Here's compared to typical. Again, you can sort of see the turnaround this last week. There's again no way to know. You can see there's some bounce in this number historically, but the big takeaway is just at the beginning of this year, halfway through first quarter, very uncommon to have price reductions. It was only 62% or 65% of normal. Now you're at 160% of the frequency that you'd expect. Here's the magnitude of overbidding, and this is the median overbid. So this is somewhere around 4%. The average, and this means that half the offers go for over 4.5% above the seller's ask price, 4.5% go below. The average, if I'm remembering correctly, is at 7%, and that tends to be higher because prices tend to be very stiff below 100% of the seller's ask price, and they tend to have some people coming in, 100% over the seller's ask price. I think I saw one that was 200 and something. I should have flagged it, but I didn't think of that until just now. But, so the average is always higher, and that average number is somewhere around 7%. The median is at 4.5%. Here's compared to typical. The overbidding that we're seeing now is a little bit less than typical based on median overbidding. Here's the frequency of overbidding. Again, you're a little bit less, but you're still 70% of the sellers in all of Silicon Valley. That's 3 counties, San Mateo County, Santa Clara County, and Alameda County, are getting more than their asking price for escrows that are closing in the past 5 weeks. Now, granted, those offers were negotiated 6 to 10 to 12 weeks ago. So you're looking in the rearview mirror. And again, you can see there's a little bit of a time shift where normally this doesn't roll over and start coming down to almost the beginning of third quarter. It clearly happened here at the beginning of second quarter. This is the frequency compared to normal. So you went from overbidding being more frequent than normal just, a quarter ago to now being less normal. And, you're still 93% of where you'd expect to be on frequency. Here I made very minor changes to my appreciation graph to go in there. The concept is the same. You can either say we had 12.5% appreciation for 8 years and about 3 1/3% appreciation for the last 3 years, or you can say we had 11.4% overall. I think the first one is a little more accurate because, you're staying closer to the data. What's interesting is we're rolling over, but we're still not coming down on seller ask price. Now, this could also be market mix, especially with San Mateo County having higher number of sales. Are those transactions less sensitive to interest rates because people buying in San Mateo County do lower loans? Don't know if it's true. I'm just throwing out a hypothesis. There's market mix shifts that do impact the sold price, which is why I break data down into micro markets. You have less market shift impact. So the reason the median price could be climbing right now is not individual property values, which is one option, but if more expensive homes or less expensive homes that are more dependent on loans and people taking on a commitment to actually have money to pay that mortgage, if those are decreasing, those tend to be on the lower end of our price scale. Now we're moving on to distributions. The key takeaways here is the purple line is the current week. So the current week, May 10th, 2025. The dotted line down here is where we're going to start off and where we were a year ago. So a year ago, the market was quite a bit hotter. And the key, what you want to look is the dotted line going up, cooling, going this direction, or is it continuing to get hotter? And you can look ahead of it already and see, I don't see any dotted lines further down. So I believe that this is about the peak of the marketplace last year. And when I start the button right now, you saw the climb. It wasn't much. There's another climb, another climb. So basically, this is where you'd expect the market to be normally climbing and slowing down. And then we're going to keep going up on the dotted lines. We're not going to get to the blue, which is the slowest, longest marketing time that we saw. But here's your rapid end of the year increase. There's the peak right around December 27th. Now your rapid acceleration. There was the peak for this year. So the peak for this year was February 21st, and now you're coming up on the current data right there. So I don't know what episode, I should go back and find it, but sometime probably in March, I said that sometime right around Valentine's Day, the market shifted. With more and more data now, the market appeared, in my opinion, based on my data, which I believe is accurate, the market in 2025 shifted by February 21st, and that's looking back in the rearview mirror for 5 weeks. So you got a 5-week period ending on February 21st, going back on when the market shifted based on days on market. Same concept here now with price reductions. This is the seller taking the large price reductions. The purple line is the current line. The dotted line is where we were a year ago. Clearly, the sellers are taking more frequent, which would be along the axis here. You can see here last year, only 10% of the sellers did price reductions. This year, we're all the way up to 15%. So you've had a 50% increase in the frequency of price reductions, but you've also had a magnitude shift. Here, you're taking at 10%. Well, let's do something a little more interesting. Here at 7.5% of the sellers were doing a 3% price reduction. Now that same 7.5% seller is doing a 6% price reduction. So we're going to step through and see the opposite. See, it's already cooling down the dotted line from last year. Again, this is sort of the time of the year when you typically peak out, and having cooling data at this time of the year is not unexpected. But what we're going to come up and see where that turnaround normally happened. There's the cool off for the end of the year. December 13th was the coolest for over price reductions. There's the peak. The peak was again February 21st, and now you can see how much we've cooled off already this year. So we've cooled off a lot more this year than last year. Last year, we were fairly close to the peak of the marketplace. This year, we're well past the peak. We're past the peak by basically, 45 days, 6 weeks. Now, here's the buyer's overbidding. And again, I'm going to throw out the caveat, this is delayed, but the concept's the same. A year ago, you were up here, the highest line that's recent data. This is the hottest line ever, which was back on March 29th, 2022, which was pandemic driven right before the price correction started, which also coincidentally, I think, happened on Valentine's Day of 2022. And it just takes time for the market to realize that. Whether this market's repeating 2022 or not, I don't know. There's some encouraging signs with the number of offers turning around and coming back up. We didn't see that in 2022. So are people getting used to the new uncertainty and going on with life? That's a very real possibility. Here's the dotted line from a year ago. Let's step forward and say, yep, you can see that it started going down not much, but now it's starting to mark down. So, and again, this is lagging indicator because we need escrows to close. Instead of a December 13th timeframe, we're probably going to have something like a January 3rd timeframe. Let's see if we can't catch it. Right there, January 24th. So that's the time lag. And now you're coming up and you're approaching the peak or the current. And you can see you're cooling off already. And there's the current. So again, we've cooled off. I didn't catch when the peak was. Right there, probably. So March 22nd. March 22nd is lagging by 5 weeks. That takes you back to basically somewhere around February the 14th. That's why I say the market changed sometime around Valentine's Day. Here's looking at inventory of the 3 counties. So San Mateo County being the smallest county has the least inventory, but about the normal level of inventory, not only post-pandemic, but also pre-pandemic. So San Mateo County inventory levels are essentially normal. Santa Clara County is above post-pandemic levels, but it's still below pre-pandemic levels. And Alameda County is closer to San Mateo County, where it's basically back to its pre-pandemic level. So Santa Clara County is the county that's appears to be lagging the most on inventory if you go back to pre-pandemic levels. Here's offers accepted in the same concept. You can see that Santa Clara County in the blue has the most offers being accepted. Alameda County has a little bit fewer. Normally, they're very close together. I would say normally they're even closer together than they are now. Just look back in time. The two counties sort of mirror each other. Right now, Santa Clara County is having a little bit more offers accepted with a little bit less inventory, so its days of unsold inventory is going to be higher. And then, of course, San Mateo County has the least. It's the same level of offers post-pandemic, but the level of offers pre-pandemic was clearly higher. Here's days unsold inventory. So even though Santa Clara County is quite a bit lower than Alameda County, like I suggested it would be, San Mateo County in the orange is actually a little bit lower. But two areas here where you're somewhere right around 45 days to sell your inventory, and in Alameda County, which is a slow county, is still just a tad, probably 1 day, because typically you have a 30-day and a 31-day month. You're at 62 days, and 2 months would be 61 days. So call this 2 months between friends to sell out your whole inventory. In most parts of the country, that would still be a fast marketplace. So our slowest county is still a fast marketplace for the rest of the country, even though we're saying it's slow for Silicon Valley's performance. Here's the marketing time for the 75th percentile. Alameda County is the longest. Santa Clara County is next at 20, and the fastest is San Mateo County at 18 days to sell 3/4 of your inventory. Here's price reductions. Alameda County and Santa Clara County are right at 1%. San Mateo County is at about 3/4 of 1%. It looks like maybe 60%. So that would be, that's actually 1%. So it'd be about 0.8 of 1%. Alameda would be at 1%, and Santa Clara County looks like it's about 1.1% price reductions. Here's the frequency. Alameda County's got the most frequent price reductions at 17%. San Mateo has the least at 11%. Santa Clara is at 14%. Here's the magnitude of overbidding. Alameda County, even though it's the slowest county, has the most overbidding. And that very likely could be sellers are reducing their prices there because they're not selling. Now they've overshot the market or below market. And even though they've been on the market for a long time, that's enough to come in and entice buyers to overbid. So the county that has the slowest marketing time has the most aggressive overbidding. Santa Clara County and San Mateo County are real close together at 106% for San Mateo and 106.5% for Santa Clara. Here's the frequency. All three counties come in very close together. Santa Clara County has the most, and San Mateo has the least, but they're on real close. Call it 70% of the sellers, 7 out of 10 sellers getting more than their asking price. Here's the long-term appreciation. Santa Clara County has done by far the best up here at 120% appreciation. San Mateo and Alameda County are very close together at 80% appreciation since the last 9 months of 2015. Here's the median price. Santa Clara and San Mateo County are again exactly equal at $2,100,000 for the median price. Alameda County remains the affordable county at something like $13,750. Here's the same information on regular paper. The previous slide was logarithmic paper. Here's the estimated payments. You can see the payments for Santa Clara and San Mateo County are the same. Drop down because prices drop down 1 week in San Mateo. And in Alameda County, you pay about $10,000 a month in payments, including taxes and insurance for the median priced home. Here's my heat maps. This is active inventory compared to the 10-year median. Silicon Valley as a whole up here at 135%. Santa Clara County, 129%. San Mateo County, 151%. So San Mateo County has got the most inventory and more inventory than normal based on the past 10 years. And Alameda County is in between at 142%. For the first 3 slides, I only have countywide data for Alameda County. Here's the number of offers accepted, same concept, but it's blue because now you're below. Silicon Valley only has 75% of the offers you'd expect, exactly what Santa Clara County has. Saratoga Los Gatos has 100%. Los Altos Palo Alto has 92%. You got Cupertino Sunnyvale at 93%. The pattern I'm seeing is the expensive areas in Santa Clara County and San Mateo County, but areas of high-priced homes seem to be doing better than those that are low-priced, dependent on loans. And then Alameda County is down at 70% of the offers that they would expect. Here's the days unsold inventory. So now you look at the ratio between the two. 70% slower than normal for Silicon Valley, 78% slower for Santa Clara County, 62% slower for San Mateo County, and 76% slower for Alameda County. The bright spot remains Saratoga Los Gatos for the fastest turnover rate, and it's still faster than normal. So it's hotter than normal. It's at 73%. It's taking less time to sell homes. And that was because inventory was down and offers were up, if I remember correctly, from the previous 2. So I think all 3 slides for Saratoga Los Gatos are red and pink in color, where everybody else is blue or white. Here's the ratio in just raw count. So even though the previous slide, when you compare it to the 10-year median, was blue, here you got a fair amount of red. So that's saying that even though we're slower than normal, we're still pretty much on fire in these areas. Alameda County sort of balanced. The more affordable areas in Santa Clara County are in balance, but the more expensive areas in Santa Clara County and the San Mateo area is, going faster than normal. I mean, 27 days, that's a very respectable speed. I consider up to 42 days to be a fast marketplace. Here's marketing time. You can see that most of the marketing times here are under the 3 weeks to give it pink in color. So again, even though we're slower than we typically are, we're still relatively quick. Here's the price adjustments. Now you're starting to see blue. So sellers are doing more price adjustments than they typically do. And this is average price reductions. But you can see the magnitude is fairly small. The biggest numbers I'm seeing in Santa Clara County are around 1.5%, 1.8% in San Mateo County, 1.4% in Alameda County. Here's the frequency of those price reductions. So it's still very uncommon for sellers to do their price reductions, mostly under 15%, and mostly under 10% of the sellers do a price adjustment. Here's the buyer's overbidding. So you still have overbidding. And again, I'm going to throw out the caveat, this is lagging behind, but you can see 6.6% for Santa Clara County, 6% for San Mateo County, and the high one is 8.2% overbidding for Alameda County. And the frequency of overbidding, Alameda County has the second most at 70%, San Mateo at 69%, and Santa Clara at 72% of the bids, offers accepted or over if the seller's ask price. Here's the appreciation. You can see where the areas in red were the most appreciation. The areas that used to be a high premium for convenience to workplace have had the least appreciation because of remote working, most likely related to COVID. Here's the sold price, and instead of just having the median number, the middle number, I sandwich it with the cheapest 10 percentile on the left and the most expensive 10 percentile on the right. So you have a price range in each one of your areas. Here's a table summarizing. You can start on the left-hand side in your micro market areas or in your price range over here and see the market conditions. And basically, when you look at the market of Silicon Valley, we're on fire, but compared to where we normally are, we're cool. So we're cooler than we normally are, but we're still on fire, if that makes sense. Here's the raw numbers for you. And this is the offers that are accepted. We can see that the current week is 2181, which is actually the third lowest level of offers we've had in the last 25 years. The 2 years that were lower levels were 2020 because of the pandemic and 2023 after the 2022 price corrections that we experienced here in Silicon Valley. So you have the third least number of offers out of the last 25 years. Moving on to the actual raw data, you can look at the data for whatever county you're most interested in, Santa Clara County, San Mateo, or Alameda, or Silicon Valley combined. Basically, you can see the number of new listings is flat from the last week to this week. Active inventory is growing up. It grew up 2% for the valley as a whole. Alameda County saw the biggest increase. The number of offers fortunately increased at about almost the same rate, 1.7 versus 2%. So we're not getting any worse off. In fact, I think I'm noticing a little turnaround in the marketplace. Your days of unsold inventory is basically unchanged. 0.2 of a day is no big deal. My threshold of concern is where it goes up 5 days in any given week. It's actually down in both San Mateo County and in Alameda County, which is an improving marketplace. And the number still is fairly reasonable. 43 days for San Mateo County, 45 for Santa Clara. Alameda County is doing a little bit slower at 62, but it's got the most overbidding. And anyway, you can go down, you can see the appreciation. Santa Clara County, 119%, because you got to subtract off the original 100% that you started with. San Mateo County, 83% appreciation, and Alameda County, 80% for an overall combined rate of 102% appreciation. The price ranges for you, and then the appreciation just since the pandemic, for those that are interested. The numbers are quite a bit lower, but you can see that's where Silicon Valley really shined, because Alameda County and San Mateo are both the same before and after the pandemic, where Santa Clara County did 53% since the pandemic versus 32% for the other two counties. We've been talking about the Silicon Valley real estate market. We will be talking about the Greater Bay Area, 13 counties and 5 regions next. You can get to the archive by typing in the long blue YouTube link, or you can type in the shorter customized green root URL. If you want to join the live presentation Saturday morning at 9 o'clock, just type in the green root URL plus the year 2025. And if it asks for the passcode, here it is for you. The handout is posted. The video will be delayed. You type in the green root URL plus the letter H for handout, the year, month, date that you're interested in. So this one would be 2025-05-10, because the presentation is on Saturdays. And any specific episode, you can jump right to it, or you can use the YouTube link. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers in single agency transactions here in Silicon Valley since 1981. Appreciate likes and subscriptions. Let's get on to the Greater Bay Area. Here are the 5 regions. And here's the first data slide. You can see that inventory is up in all 5 regions, climbing more significantly in my eyes here in Silicon Valley. It would be the steepness of the slope, or even just the percent gain. It's tripled in magnitude in just the amount of time, where your other counties, North Bay has roughly doubled. And then Central Valley is only going up by 75%. And Central Coast is close to doubling, but not quite doubling. And the cities has doubled. So maybe the cities has gone up the most because you've gone from some number right around, gotta get my bearings, about 350 to some number around 750. So you just over doubled. And I guess Silicon Valley is just over doubled too, because it's gone from a number somewhere around 925 up to about 30, up to a number somewhere right around 3,200. Moving on to the offers. Here's the dip I was talking about. See how Silicon Valley came down and went up? The other areas have just gone up. Central Coast has been going on a coast downhill, but that's one of the reasons I look at the different regions. The marketplace in Santa Cruz and Monterey is completely different than the marketplace in other areas, in part because of the closeness to the coast, and those things drives a lot of the vacation coastside properties. And the other three regions, the cities down here, the North Bay up here in the gray, or the Central Valley in the yellow, have just kept on climbing as far as the number of offers, where Silicon Valley did this little dip right after the announcement of the tariffs and the stock market correction. But notice how we've turned around and we've climbed back up. We're not quite back up to the level we were at the beginning of the quarter, but we're only a little bit short. And at this point, I would say that we'll probably be there next week. And then after that, we'll be resuming our growth most likely. So I don't know why Silicon Valley was hit harder than the others. It might be that more people are invested in stock here in the startup capital of the world. There's no way to know those details. The analysis here looks at what the overall market's doing and trying to give leading indicators. Here's your days on sold inventory. Here, a high number like in the Central Coast. The higher the number, the slower the marketplace. And that's, about 86, 87 days now, which is getting to be long. But notice historically that Santa Cruz, Monterey has always been on the high side. It's, each market has its own characteristics. Then you have North Bay, which is going along right around 80 days. And then after that, you have the Central Valley at 70. And now you come down to cities at something like 57 days. And then Silicon Valley is sitting down as the fastest at just over 50, probably about 52 days. But the trend is not up or down except for the Central Coast. You can see that Silicon Valley was increasing, but it's leveled off. The cities has leveled off. The Central Valley and the North Bay have been basically level for a while. Here's the marketing time for 75th percentile sellers, so 3 out of 4 sellers. We can see the straight climb up in Silicon Valley. You can see there was a jump in the Central Coast, but it turned around. The North Bay turned around and came down. Central Valley's been flat. The cities has been fairly flat. So once again, the one that's been doing consistently the least well is Silicon Valley. But again, it typically goes up at this time of the year, and it almost appears to have gone up steeper in 2024. It was flatter in the other years, but it's not an alarming rate of increase. And again, 22 days to sell 3 out of 4 homes, 3 weeks. Here's your price reductions, all still very reasonable numbers, but greater than you'd expect. The level line would be up somewhere right around here, about a 0.5% price reduction. Right now, you have the Silicon Valley and the cities taking less than 1% price reduction. This is the average number, and remember that the vast majority of people don't do any price reduction. So even here in Santa Cruz, Monterey, where the sellers are taking the largest price reductions, it's only 2%. Here's the frequency of that price reductions. You can see it's climbing in all 5 regions. It's still very reasonable. 30% up here. So I would say not quite, but pretty much every region is at 25% or less. So less than 1 in 4 sellers. And when you come down to the cities or Silicon Valley, where I do my practice, you're at basically 14.5%. So that's like 1 in 7, 1 in 6 sellers doing a price reduction. And I guess it's closer to 1 in 7. Here's the magnitude of overbidding. You can see that the amount of overbidding. So this is how high over on a percentage basis buyers go on the seller's ask price. You can see the cities is staying pretty flat right up to around 9.5% overbid. Silicon Valley has come down and is now at 7%, but that's right about where it typically is. The other 3 counties, North Bay has a little bit of overbidding at somewhere around 1.33% overbid. And then you have the Central Valley and the Central Coast. To me, it looks like the Central Valley is right at or just a sliver under 100%. So their offers are coming in at right at the asking price. Central Coast, Monterey, and Santa Cruz is slightly below, but still right up there. Maybe a 0.1% discount. So they're getting, on a $1 million house, they're coming in 0.1% below that, which is 0.1% is $1,000 reduction. So essentially nothing. But again, that's the average. Here's the frequency of the overbidding. And you can see that the least amount of overbidding is the Central Coast. And, we've been beating up on the Central Coast a little bit in this presentation. But I mean, they're still just shy of 40%, something like 38%, which is more than 1 out of 3 sellers. You come up here to the Silicon Valley, and it's just a hair over for 70%. And the cities is just a hair under 70%. And then just to round it out, you have the Central Valley at 40% and the North Bay at about 47% overbid. So overbidding is still common. So you can't complain as a seller if you're selling your house in 3 weeks and you're getting more than your asking price, which is what the typical seller is getting at this point. Here's the long-term appreciation. You can see that in the orange, the cities has the least amount of appreciation, but that's still a little bit over 50% appreciation since 2015. Silicon Valley has the most up here at about 105% appreciation. And again, the axis includes the original amount, which is why it's 200, but the real appreciation rate is only 105%. Then you have the Central Valley and the 90% appreciation, Central Coast at 75% appreciation. And finally, the last of the four, the fourth out of the fifth is the North Bay at 70% appreciation. So real estate has been a good long-term investment. It's panned out the best for Silicon Valley, but that's just the way things bounce sometimes. Here's your median sold price for the 5 regions. You can see that the cities is the highest right at the moment at something around 1.8 million, followed by Silicon Valley at something like 1.7 million. Then you come down to the Central Coast at about 1.1 million. North Bay at about 800,000. And the most affordable region is the Central Valley at somewhere around 550,000 for the median priced home. You can see that all regions are back basically roughly right where their peak was for 2024. You can also see it's for most of the regions, Silicon Valley is the exception. They're just below or below their 2022 peak. So clearly had a lot of appreciation early in the 10-year cycle from 2015 through 2020. Here I'm comparing peak price to peak price. Back on the previous slide for appreciation, I'm going back to 2020. We had a rapid appreciation from 2015 through 2022. And basically since 2022, we've been basically flat. It depends on when your activity is happening. If your activity happened here in 2022 and your activity is happening now, you've had appreciation. But if you were at the peaks, and we're essentially at the peaks, so if you compare peak to peak to peak, there's been basically no appreciation since 2022. Here's an estimation of the payments. I'm using the federal rate for conforming loan limit published by the Federal Reserve Bank. You can do better than that because for many years now, the jumbo money, which many people that are doing a loan in Silicon Valley would be using, is less expensive. You also have a lot of banks that have banking relationships, so you can keep your stock portfolio with the bank's stock partner and get a lower interest rate, or you could go an adjustable loan, or you could pay all cash. But this assumes an 80% loan at the Freddie Mac national average for high balance conforming loan limits. So it's sort of an artificial number, but it allows you to see what's happening, the impact of interest rates, and the impacts for a more competitive interest rate is roughly the same because the delta stays roughly the same. So you can see, and the reason I include this is I feel that, although a lot of people are focused on the price, I think houses sell more on the payment because someone that's taking out a loan is signing up for a 30-year mortgage payment, and someone that's buying a house, property tax is something you're paying anywhere. So here you have the table with the metrics going across the top, and then you have the different counties coming down the side with the different regions. I believe that although the regions may give you, like the Bay Area may give you a concept of what's happening in the greater Bay Area with one set of numbers, I don't believe that is reflective of all of what's happening in any of the 9 counties. So realistically, I think what you have to do is look at what's happening in each of the county and then in the micro market areas within each of the counties. But you can come up here and look at the metric, and I have what it is now, the current week. I have last week's, and I have basically a month ago, 5 weeks back in time. So you can see the recent trend all in this one table. Here's again where we started off. So these are the chapters you can jump to in the YouTube description. Thanks for joining. Take care. Bye for now.